Hey, ladies and gentlemen, and welcome to today's presentation. Today's brief webinar, we're going to discuss about some other ideas on managing stock positions that are down. We had a couple queries about this over the past few weeks and during our open discussion presentations on Friday afternoon. So we wanted to spend some time today just to look at some of the alternatives to manage a stock that you have that's currently down in price. Now before we begin, I just want to introduce myself. For those of you that don't know me, my name is Mike Chupka. I'm the Director of Education here at Power Options. Power Options, of course, is a patented suite of tools for self-directed options investors. We support search tools, analysis tools, and research tools for over 23 of the most commonly used option strategies. And of course, in addition to the search and analysis tools, we also have tools to help you manage your positions, such as the portfolio tool, some signature tools that we're going to look at today as well for repairing or insuring stock positions, and also a variety of different help videos, tutorials, and archived webinars to help investors get more familiar with the concepts of options tradings and the various option strategies as well. Now, in today's presentation, of course, we're going to discuss some of the ways to just look at how we can manage a stock that's down in price, some of the pros and cons of some of the common management techniques and other management techniques also. Regardless of our strategy, whether we're trading long stock, whether we're covered call investors, whether we're selling out-of-the-money cash secured naked puts, or potentially even, bull put credit spreads, we may be forced to buy shares of stock or have a stock position that's down from where we bought it. Now, there's some common ways to manage these positions that I'm sure you're aware of. We're going to review those. We want to show some alternative ideas as well to maybe help you get back to break even faster. Now, for those of you that might just be in a long stock position, well, the common preemptive management that you may use is you may enter your stock position. You may choose to use a mental stop. Hey, I bought a stock at $50 per share. I don't want to lose more than 7 or 8% of it perhaps, so I'm going to set a stop loss or a mental stop that I'm going to look to close the position or get out of it if the stock drops to $57 or $56 per share. Now, the problem with a mental stop, of course, is it's very easy to talk ourselves out of this. So I bought a stock at 50 with a bullish expectation. Over the next few days or maybe even few weeks, the stock drops down to $46 per share or so. And I say to myself, well, it's just the market. It's weighing down as a whole. This stock's still going to come back up. So I stay in the position. Now it drops down to 44 and maybe 43. And then I consider, okay, well, now I'm 7 points down on this position. Maybe I can consider some alternatives to manage. But, you know, it still just seems the market's weak. It's going to come back. And before we know it, the stock's maybe down $39 or $38 per share. And we're looking at a 10-point loss on the position. You know, well above 25%. So the mental stops are very concerning because it's really assumed insurance, and if you don't adhere to it, you're going to find yourselves holding losers longer than you thought you would. Now, using a standard stop order to prevent loss can work in common market conditions. Of course, we all know this, whether we're doing covered calls or whether we're doing long stock positions or things of that nature. We set our stop order with our broker at 7 or 8% or maybe even 5% down from the current stock price. Well, if the market just pulls down gradually, hits our stop loss during the intraday trading, we get closed out of the position. Okay, so we took our loss. We're going to look to manage it with other positions, make it back with maybe other long stock positions that are hopefully more bullish. However, of course, they all might be falling down at that time, and we get a large swath of stocks that get closed out. And, of course, the biggest thing that bothers investors is the stock drops down to your stop order. You get closed out for your 5 or 7% loss, only to see in the next 2 to 3 weeks the stock move up well above your purchase price without you taking advantage of it. Of course, you can always buy back into the stock if you still have a bullish expectation, but that, of course, can compound losses if the stock continues to fall. The stop order is usually where investors realize the largest loss. And the reason why is I set a stop order. The unexpected event happens due to earnings, just any kind of bad news that comes out of the company. The stock has a sudden overnight or pre-market gap of 20 to 25 to 30% decline. We get closed out not at our 7 to 8% stop loss, but we get closed out whatever the market can offer. So before we know it, we've got that realized 25 or 30% or 33% loss on the position. That's very hard to make back. Many of you are familiar with the gambler's ruin. where if I have a 25% loss on a stock position, I'm going to need roughly a 33% gain on my next position or on the remaining money from that trade just to get back to break even. And if I have a 33% loss on a position, I'm going to need roughly a 50% gain to get back to break even as well. And of course the trailing stop order is very similar, so the stock moves up, we have that trailing stop order that adjusts with it, but in the sudden decline, that unexpected event, we end up getting filled for a worse position or loss greater than what we expected. Now, what are the common management techniques that you've probably used, and I've used honestly in the early days of trading, if we're in a long stock that is down? Well, the first basic concept we're taught is we can average down. I bought a stock at 50, it drops down to $45 per share. I buy another $100 shares at $45 per share, and my cost basis is now $47.50. So my 200 shares, I only have a $2.50 loss, might be easier to make back, as opposed to 100 shares with a $5 loss. The monetary loss is the same. We're still down $500 roughly of our total investment into the position. Some of you, of course, if the stock drops maybe 5 or 10%, if you're just trading a long stock for growth, you may try to sell a call against it after the decline, just to generate some premium, help cut down the loss. The problem with this, though, is that you could lock in a larger loss, or not a larger loss, but you could lock in a loss. So we have that stock, bought it at 50, it drops down to 44, we're looking at a $6 loss on our position, a little bit above 10%. I figure I can sell a 45 call 1 month out, generate $1 in premium, now the stock's at 44, and this will cut my loss down to only $5 instead of $6, and then I'm going to hope to manage it. Well, what happens now if whatever news and event that happened and pulled the stock down, the market considers that an overreaction, and it suddenly goes back up to $48 or $49 per share, closer to where we were? Well, now if we get a sign at 45, we're taking a $5 loss on the position, so we may have to roll it, but it's going to cost us more to buy back the call to roll it, and we may be in this position now where we're rolling consistently. Now, of course, there's other elaborate repairs. Some of those we're going to look at today. You hear things about broken wing butterflies, box spreads, calendar ratio spreads, and things of that nature. These get a little complex. And the problem that we face with some of these common management techniques for a stock that's down or a covered call that's down even, we'll look at that in a moment, but the idea of averaging down, well, in order to get back to break even, we need the stock to move back up in price. Things such as these broken wing butterflies or these calendar spreads and calendar ratio and box spreads around a stock position using 4-leg or 5-leg positions and options, they typically require the stock to move back up in price as well to get you back to break even. Most of them do. I'm not going to lie to you. I'm not going to show you something new today where you can get back to break even if the stock continues to do nothing. Okay? But you look at it this way, when you sell a call against the stock after it's fallen, you're really in a neutral position. We don't want the stock to go up anymore. We want the stock to sort of stay at our lower strike price, hope this call expires, and then just continue to sell calls against it to try to get us back to break even. So the averaging down, and so the more elaborate repairs, those require a bullish move on the stock after the decline. Selling a call against it is really a neutral repair strategy. We don't want the stock to move back up after the decline. You want it to kind of hang or stagnate to see what can happen as well. Okay, so let's move on very quickly here. Common management of a covered call position. So instead of buying the stock at 50, I was looking to make, let's say, a 3 or 4% return for a 30-day or 20-day trade. Bought our stock at 50. I sold maybe the 50 call for $1, 25 to 30 days out in time. My hope is that the stock would move up. I'd get assigned and take that sort of 2.5 to 3% gain on the position. But instead of that happening, the stock drops down to $44 per share. Now, I keep most of my dollar premium, of course, so we've lowered our cost basis down to $49, but we're still looking at a $5 loss. So as we would have with the long stock, how can I help repair this now? Well, with the stock at 44, we're not going to get much for that 50 call that we originally sold because it's now deeper out of the money, so we may have to sell the 45 call. But again, we're just rolling the call down in price, and we haven't repaired it. We're still looking at, let's say we collect another $1. So now we're still looking at roughly a $4 loss on the position. We don't want to get assigned at 45, of course, because what we've done by rolling down the call, say we took our original covered call here and we had to move it down further in strike price, so we have a lower potential gain or potential loss on the position. We don't want to be assigned and lock in that loss. We're hoping that the stock, again, stagnates and hovers around this $45 to $44 range, so our call will expire. We can sell another 45 call, get another dollar in premium, and lower our cost basis further. Now, some investors will try to repair the loss all in one shot. So again, let's take a look here. We've got a covered call. We're going to use better graphs in a moment when we get to power options. We're just using this as a rough example. We sold a call at 50, and our stock proceeded to drop down to $44 per share. Now, I kept the dollar premium, so we still only have a $5 loss. We paid 50, keep our dollar. We've got a $49 cost basis on stock trading at 44. And I see now maybe I can sell the January, let's say 2016 $45 call, let's say now for $4. So instead of selling the 1 month out, which I might only get 80 cents to $1 for, we go now 8 months out in time or 9 months out in time and collect $4 in premium. So let's say we're pretty close now to break even, aren't we? The stock's at 44 or 44.50. We sell the 45 call for $4. So we've lowered our cost basis from 49 down to 45, and we're holding the 45. So we're basically at a break-even covered call. But remember, this $4 in premium, did you repair the position? Yes. You've turned what could potentially be a loss into a break-even if the stock's trading right around $45 per share, but 8 or 9 months from now. You're not going to see a lot of time decay on this position, especially if the stock stays in this price range for 2 or 3 months, until about 6 months from now, when you get the last 2 to 3 months towards expiration. So this repair can work. Sometimes I've heard it referred to as a slingshot or the far-out loophole, things of that nature. Just go further out in time and sell a call for a higher premium and you'll be fine. But now you're holding this position in your portfolio for 8 or 9 months, just hoping for some time decay. And if the stock continues to fall, one of the problems is rolling out to that further time frame is that if I'm all the way out to January 2016, and if the stock doesn't offer other leaps, if it doesn't have the 2017, if the stock continues to fall, all I can do is roll down in this month until further expiration dates appear to get a higher premium. And remember, in a covered call situation, as the stock falls in price, you're always losing more on the stock, which is essentially 98% of what you invested in, than you're going to be able to gain back by rolling down calls or selling new call positions. Okay, that's just the way the options work. So you're not going to be able to make back more than you've lost on the stock unless you go extremely far out in time, but now you're kind of already agreeing that you're going to sit on this stock and have it in your portfolio and that capital allocated to this position for the next 9, 10, or 12 months out in time. So these repairs come with a slight flaw. The other main flaw that we're going to look at as well with this type of repair, just rolling the call down or rolling it farther out in time to get that higher premium, is you do hedge your cost basis some, but you still haven't addressed the downside. The stock can continue to fall down in price, and you're continuing to manage it potentially when that happens. And of course, we'll talk about very quickly the common management of a naked put, parity trade to our covered call position. We may be forced to buy stock below the break-even. When I sell a put option, we had a stock at 50. Let's say we sold the 47.5 put, slightly out of the money, generated maybe 50 to 80 cents a premium, and our stock gaps down to $44 or $43 per share. We're going to be forced to buy shares of stock at that price. All right? We're going to be forced to buy shares of stock at $47.50. We have a lower cost basis. We have less of a loss, but now we are owning stock that has an unrealized loss. So what are the common ways to manage it? Well, we could consider selling it a covered call, turning it into a covered call now that we own stock. And of course, we face that same dilemma. Do I just sell a 1 month out and try to generate 80 to 90 cents month by month, or do I go for the whole gusto, sell an 8 or 9 month out call, try to get that $4 to $5 back right now? Might be easier with the naked put, of course, but now we're stuck in that position for an extended period before we realize that time decay in our favor, can actually realize some of that $4 premium. And of course, if the stock falls below our put strike price, if it's not a sudden decline, we're forced to buy the stock early with early assignment on our short put. But if the stock just falls gradually, of course, we may look to roll the put down, similar to what someone would roll the call down on a covered call position that's declined in price. We already talked about those issues as well. Now, are there ways to get back to break even faster? Sure. There are some different ideas. We talked about the broken wing butterfly that we'll look at as well. Stock repair is a simpler way that might help you get back to break even faster. And what we do in the stock repair is we're going to look to buy calls that are at a similar lower strike price. So if I had a stock at 50, it dropped down to 44, I may be able to buy a 45 or perhaps even a 42.5 call and then sell twice as many of the higher strike, say the 45 or the 47.5. What this essentially does is it creates a covered call position. One of our two short calls will be covered by the stock ownership with a bull call debit spread. And this essentially helps us get back to break even faster because we get the difference in the bull call debit spread as the stock moves back up. And we still keep the premium from the two calls that we sold. We can get back to break even faster without managing the covered call as well. Now, this isn't a be-all, end-all of the best repair in the world because, as we're going to see, there are still some pitfalls with the stock repair. But we can combine it with other strategies. So even if you have a 10 or 15 or 20% loss on your stock position, it is possible that we can combine some of the other ideas we looked at as the common management techniques with the stock repair to still get back to break even in the case of a 20 or maybe a 25% decline on our stock position. Okay, well, let's take a look at some of these in action. And what we're going to do is just use power options. We're going to put in some stock prices and stock positions. We're going to evaluate the common rollout opportunities. We're going to take a look at stock repairs as well. And at this time, I of course want to encourage any of you who want to share with us your positions. Of course, we won't give the first and last name. But if you have a stock that is down, use the question pod on that GoToMeeting platform and go ahead and send me your stock symbol, your cost per share, and the total number of shares as well. All right, well, let's go ahead and navigate over now. 1 second. There we go. I just want to make sure we're looking at the right. There we go. Okay. Sorry about that. Let me go ahead and change the screen here to the Power Options suite of tools. I want to make sure that comes up for everyone. Okay, there we go. All right, so first off, I'm just going to take a general look right now as where is Apple. So let's go ahead and take a look at the quotes for Apple here on Power Options. Oh, this is going to be perfect. Apple's right at 125.46 right now. Okay, well, let's use some examples of this position. I'm going to go into the Power Options portfolio tool, and we're just going to create a brand new portfolio from scratch. And we're going to go ahead and call this our stock repair portfolio. And let's start off with about $100,000 cash on hand as a test portfolio. Copy that over. I'm going to set the date back to 1 month. All right, so let's go ahead and save that. And I want to go into the portfolio. We have some suggestions that have come in as well. But first, before we take some of the stocks that have come in, let's go ahead. I'm just going to put in a long stock position into our portfolio. And we saw Apple trading at 125. But let's say, I know it wasn't at this price, but let's say about a month ago, March 8th, we bought 100 shares of Apple with a cost basis of $150 per share. So keep it simple, just 100 shares at $150. And let's see what that looks like. So we know now we're at about a 16 or 17% loss on our position. We're down roughly $24.54, close to $25 per share on our position. Now, as I'm tracking a position in the portfolio, whether it's a covered call, of course, or whether it's just a long stock position, or if I was put Apple, if Apple had been trading at 170 and I had sold the 150 put, and now it's declined down to 125, I was forced to buy shares of stock at 150, have a slightly lowered cost basis as well. But let's go ahead and go to our position actions feature and position analysis. Now, of course, this just gives us a basic profit and loss chart of our long stock position. We see a more detailed analysis of what we're looking at on this field. We know Apple's currently trading at 125, and with our cost basis of 150, we're looking at a loss of $24.54 per share as well. Now, that's a 16% loss, unrealized at this point. And with a 16% loss, we see that we could sell the May 135 call. So we've got about 37 days to expiration. It's slightly out of the money. The call premium is only $1.58. Well, we've got a $24 loss, so if we get assigned at 135, which is 10 points higher than the stock is now, plus our dollar premium, we still might get locked into a loss or assigned at a loss at 9%. Okay, so can we go out further to get a positive percent if assigned? We see some examples here of getting more premium up to $4.80, but we know the decline here is not going to help us in that scenario. And of course, let's just take a quick look at the profit and loss chart here as I evaluate rollout opportunities. Okay, and this is what we'd expect to see. We know our cost basis is 150. We sell the 135 call. Absolutely, we're going to generate that $1.58. We're going to hedge our loss down a little bit to about $23 or so instead of $24.54. But that still puts our cost basis at roughly only $14.84, $148.42 per share, and we've agreed to allow ourselves to be assigned at 135. Well, could I go further out in time perhaps and sell something that's $25? Well, let's take a look. Now that we see that we don't have any positive repairs, we're just using the covered calls from the portfolio tools, let's go ahead and, oops, I'm sorry folks, let me add this back in. I'm going to go ahead and add in our custom spread tool here, just so we can do this on the fly. So let's see. Let's take a look at all the chains for Apple very quickly. Let's add our stock shares in. We bought 100 at 150. And what is the other method we may use? Well, we may look to sell something further out in time. Okay, so let's go ahead and view the options here. I'm going to go all the way out to start. Let's try January 2016. All right, so we're going through the different premiums here. Let's go up towards our stock price range. See, even here, a year out in time, the at-the-money 125 doesn't have that bid of $24. Okay, if we go to the 135, it's only at $7.50. That's more than the $1.50 we can get right now for the May series, but the 135 only gives us $7.50. Is that going to help us get back to break even? No, it's still going to be about $7 short, isn't it? Let's take a look. So we're going to sell far out in time call, still locking ourselves into a potential loss if the stock moves up in price. Okay, so if it goes up to 135 and we let ourselves be assigned, we're going to have a loss of 5.3%. Better than the 16% loss we're looking at right now, better than maybe the 14 or 9% if assigned if we use, 9% loss if we sold the May 135, but this is 9 months out, okay, and it's still a loss of 5.3%. And a lot of people I see who advocate this say, well, that's great because you sold $7.50 worth of time premium. You're going to see that decay in your favor, and you're going to be able to use that to your advantage to repair the position. If Apple stays in a range of, let's say, 135 to 115 over the next 5 or 6 months, we're not going to see a lot of time decay in this position. It's still going to be priced around $6.50, $7 per share, even though we're gaining time over that 5 or 6 months period. We're not going to see a lot of decay in this January option until we get to that last 3 to 4 months to expiration. So we're going to be holding this for a while. The only way we'd see a rapid time decay in our favor from the $7.50 we just collected is if the stock continues to fall down in price and drops down to, let's say, $100 or $98 per share, then this 135 call for January might drop down to $3 or $2, and we'd realize $5 in premium. But in order for that to happen, we'd lose another $25 on the stock that we still own. And so that's why sometimes going this far out in time isn't exactly the best repair idea. Okay? Now, let's take a look at the stock repair and see if we can get back to break even faster. So we're going to go, there's 2 ways, quick ways we can navigate to the stock repair. Number 1, I could just put in my stock symbol here up at the top and click on the stock repair link on the upper right hand side. Or we could go into the signature tools and go right to the stock repair as well. So we've got Apple. Our cost per share is $150 and we own $100. We own 100 shares. All right, so let's go ahead and submit that and take a look. Now, what it tried to do here, oh, how about that? In this case, with that $25 loss on the position, and this is okay because this is what I figured would happen with this 16, 17 point loss. What this tool tried to do is build repairs for us using the different strike prices, and it kept them kind of close. So what it tried to do is simulate buying the 125, the current at the money, and then selling higher strike prices in that 2-to-1 ratio. and it looked at the ones for the available credit to see if it could help us get back to break even faster. But in this case, the stock repair doesn't show us any break evens until we get out to January 2017. But let's take a look at that one. I want to take a look at this far out repair for the simple concept of showing you why I wouldn't do this far out in time. But let's take a look at it. So when you run the stock repair tool and you see the availability of repair details and the new break even, so this ratio spread combination that we could use with the January 2017 125 calls and the 135 calls, when we see the repair details are available and a break even price is available, let's click on repair details first. All right, so we're shown that on this particular repair, we have our cost basis of 150. We're down 24.54. We knew this already. Our stock's trading at 125.46. We could buy one, okay, equal to the number of shares we own. We could buy one January 7, 2017, 125 call, at 1880. We could sell two January 2017 135 calls for 1420. So we're going to pay 1880 out for that one call. We're going to collect 2840 for selling these two calls, and this gives us a net credit of 960. So we're going to take $9.60 in now, more than we could get for selling the at the money January 2016 call, which is priced at 750. But at the same time, what does this do for us? If we're only collecting 960, that would roughly put our break even at 142.40, right? I'm sorry, or 140.40. Okay, $140.40. How is our break even at 132.70? Well, as we scroll down and look at the chart below, we see here that if the stock was trading at 132.70, remember we'd have a loss of $17.30 from our original price of 150. We took in 960 for that initial net credit. But if the stock's trading at 132.70, that one January 125 call is now $7.70 in the money, and the 135s are still out of the money. So we have $7.70 of value in our long call. We keep the 960 credit. This gives us that $17.30 back, so we're right at break even. And of course, we could make more of a profit if the stock went up to 135 to the max range. Okay, and then down below it just shows you some base discussion on what happens if the stock is above 135, if it's between your strike prices, or if it's below 125. All right, now let's take a look at the Analyze Trade function here. The repair details is good because it shows you the breakdown of what you would do manually to repair this position, if available. But if we go to Analyze Trade, this gives us that bird's eye profit and loss chart view. We have 100 shares of stock at 150. We can buy one January 125 call at 1880, sell two 135 calls at 1420. That gives us that net credit of 960. And now we see for our repair, if the stock's trading right at 135 on January 17 expiration, we'd have a profit of $460 or 3.3%, even though the stock has not reached, still 15 points below our purchase price. But again, why wouldn't I do this repair technique, even though it helps me get back to break even faster and I don't need the stock to go all the way back up to that current price? Well, the reason why for me is this time frame is too long. Just as I talked about the flaws with rolling a covered call all the way out 12 months or 15 months or further out in time just to get that premium back that matches your criteria. Remember, with this position at 1420, I could probably sell just the January 17 135 call by itself and collect $14, and this would put us very close to break even without having to do the ratio repair. But again, I'd be sitting on this for an extended period of time before I realize most of that premium. And the difference here is that max return that we'd get here at 135 of only needing the stock to go back up 9 points before we realize that, that only happens at expiration, which is a year and 8 months out in time. And we see here from this red profit and loss chart on March 1st, 2016, not March 1st this year, but March 1st, 2016, the halfway point between now and 2017 expiration. If the stock is trading at our break-even price of 135, we'd still be looking at a loss of $1,400. theoretically, because the call premiums are not decaying in our favor. So is there a better way to repair this? We didn't see any good stock repairs. We don't see any covered call opportunities unless we go really far out in time. Is there a better way to maybe get back to break even? Well, we could combine ideas. We could take one of our common management techniques and maybe work with the custom spread here to see if this, the stock repair, to see if it gets us back to break even. Now, how do we do that? Well, of course, we have to factor in the concept that maybe in order to get back to break even faster or to find a good repair, we're going to have to average down this position. So, for example, if we buy another 100 shares of stock right now, and let's call it at a price of 125. Okay, so we have 100 shares at 125 plus another 100 shares at 150. And divide that by 2, we'd have a new cost basis of 137.50, halfway between. So if I average down my position to the new cost basis of 137.50, now we may be able to just do the simple management. Let's say we saw in May it wasn't possible. Let's go out to June real quick. And if we sold the sort of at the money 135 call for 270 to 273, we'd sell 2 calls now, of course, against that position. Now in June, we have essentially a break even if the stock's staying around 135. So the average down helped us, but combining it with a covered call might get us to a small return and break even, but again, we still haven't addressed the downside. How about taking this into the stock repair? Okay, so let's go ahead and type in AAPL again. Actually, no, let's go back to our stock repair tool here. What if we now owned 200 shares at 137.50? We average down first and then apply it. Okay, so now we can go out to July, but notice here that even though with that June call that we sold the 2 June calls and we had maybe a 0.1% yield, we went back to break even if the stock was trading right around 135 after we averaged down. Here we can get back to break even. We have to go out to July to find a good one, but our new break even is only at 129.88. So again, we'll take a look at the repair details, get the broad overview. So we could buy one July 125 call for 745. Sell 2 July 130 calls at 510. So again, we take in a $550 credit right now, and if our stock was trading at 129.88 at July expiration, we keep that net credit, well, the 275 per share, 550, but the 275 per share. And our 125 call would be worth 488. So with a loss now, remember 137.50, the stock's at 129.88, we have a loss of 762. The 488 long call value plus the 275 we kept counters that, and we get back to break even with a lower price. Okay, now let's scroll back up, and as I mentioned, it's great to see the numerics, but let's just take a look at the profit and loss chart. Okay, so I'll be honest with you. This repair for the premiums that are available on Apple right now doesn't look that great. Now, what do I mean by that? Remember our June position, let me see if I can pull that back up here, we're just selling the June call for 270, 2 contracts. If the stock was trading right at 135-ish or so, we'd have a gain of $40 or 0.1%. If we look at our stock repair now, we have the 130 calls at 510, but if the stock's trading right at 130, we have a 0.2% gain. Again, this is where reevaluating your stock comes down to a very strong benefit, because after the stock has dropped, before you do any repair or any adjustment, you have to reevaluate your stock sentiment. What do I think might happen over the next 2 to 3 months? We never know. Hey, that's why we got in the situation we're in right now. But if I feel that the stock is likely going to stay in this area and I don't feel it's going to move back up above maybe 130 or 131 per share, this might be a decent repair to do for July expiration. However, if I think the stock's going to recover, it might go back up to 133, 134, 135 isn't out of the realm of possibility. I want to stay with a shorter term one and try to get myself back to break even. Think about it this way. If we sell the call at 270 right now and the stock's trading at 130, we'd lower our cost basis down to that 134.80 roughly. Okay, so we have a call space of 134.80 and June expiration with a stock trading on 133. Much easier to manage. Okay, what are the problems here? Well, the problem is now we have allocated more money into this position. We've now got roughly $26,000 in this position as opposed to the $14,000 or $15,000 we originally started with as well. Okay, the other problem is, I'll be honest, we haven't addressed the downside, and that becomes the issue. Okay, so we just wanted to show some of those ideas very quickly. We just wanted to review some of those. The stock repair can be a good idea to use. Averaging down combination with the stock repair can help you get back to break even faster, but you want to run through those different scenarios to see what's available. Now I'm going to take some of your stocks. We had a lot of stocks come in as well. So we've got Larry who wrote in and says he's got a long stock position, GSK at $53 per share, and he owns 100 shares. Am I going to promise that we're going to be able to repair every one? No, but we're going to try to give you some ideas on repairs that might work or combinations that might work for these positions. Zero commission and $53 per share. All right. So GSK, $53, currently at $47.65, so we're at a 10% loss, $535 loss on our 100 shares. Now again, I'll start off the simple route. I've put it into the portfolio. I'm going to go to position actions and then position analysis. Standard stock position. We know our loss is at 10%. With a stock at $47.65, going 37 days out to the May 48 call, only generates 70 cents. You can lower some of the loss here, but if the stock moves above 48, you're kind of locking yourself into an 8.2% loss. Okay? I don't think this is going to cut it for what we want to do. Can we go further out in time? Well, let's take a look. Let's do the same scenario, the same walkthrough we just did with Apple. Let me type in GSK. Now I don't like that covered call opportunity that appeared in the portfolio. Oops. All right. Let's take a look here. We know the stock's at $47.65. We're looking at that loss of $5.35. Let's try the January 48 or 50. Not even close. It's only at $1.25, excuse me, $1.40. November, do we have different strikes? Yeah, we do have 48, but it's only at $1.75 to $2.25. Let's call that $2. What would that look like with the new at-the-money call for November expiration? We know we're not going to get back to break even. Still at a 5.9% loss if the stock is trading above it. Better than the 10% loss if we liquidated right now, but just a simple covered call or a covered call far out in time doesn't fit the bill on this one. Can we repair this? Let's take a look. Let's go back to our stock repair tool once more. Let's go to GSK and $53 and 100 shares. All right, so this one again, because of the strike differences, a 3-point strike difference, the first credit repair comes out in January of 2017. And again, we already talked about how this might, let's just look at the trade, the profit and loss chart for that repair here on this position. All right, so we could buy one contract of our 47 call for January 2017 at $3.90 and sell two at $1.95. So it's going to give us a little bit of credit on this position, or roughly none. All right, we're not going to include commissions here, but this is just sort of a wash. But again, it's a 0% gain. In other words, it's right to break even if the stock's trading at 50, but that's all the way at 2017 expiration. But we saw something interesting back on the other page, didn't we? Something I haven't talked about yet. The tool here tried to build repairs in two different sections. One is a credit repair, which I prefer to do if possible, if a stock repair is there. We've already talked about the dangers and the sort of cons and why we don't want to consider going out this far in time, even though a repair is available. But notice down here there's something called a debit repair. And we see a debit repair on this particular position using the 47 and 52.5 calls for April expiration. And our new break even would be 50.48. Well, how does that work? Well, again, the system grabbed that ratio combination, and okay, you could probably get a little better than this actually, but it sees that we could buy an April 47 call for 95 cents. And taking the natural bid, we could sell two April 52.5 calls for 0. We could probably get 5 cents for that, so this would actually look a little bit better with a debit of only 85 cents as opposed to 95 cents. We'll take a look at that in a moment. But here, we didn't generate a credit. We're putting in a debit. So originally, It's kind of a shock. We've got a cost basis of 53. We're adding a debit to the position, but now the break-even is lowered to 50.48. Why is that again? Let's take a look. If the stock's trading at 50.48 at April 17th expiration, you have a $2.52 loss on our stock position, our original cost basis of 53. Your 47 call would be worth $3.48. And we know we paid a debit of 95 cents, so that 348 intrinsic value on our long call minus the 95 cents would put us at 252. We're right back to break even with only needing the stock to go back to 50.48. But some of the risks involved with this, of course, is that it is a debit repair. So you're putting more money into this position, another premium into this position. You're selling 2 calls against, but honestly, let's take a look at our April calls here. 0 bid, 5 cent ask. You could probably get 2 to 3 cents for it, so let's just try to put that in there as well, see what we could get for GSK, and submit that. So now, of course, we pay a debit still of, let's call it $89 per share, 89 cents or $89 per share. We're selling 2 and buying 1. This is not a naked position because our 1 short call is covered by 100 shares of stock, and then this is just a bull call debit spread. And what happens here to our bull call debit spread as the stock moves up is we get the difference here, this extra 550. As the stock starts to move up, we're gaining more back on the stock, and we're gaining more on the long call. In this case, we had to pay 89 cents for this long call. But if the stock hits that price of 52.50, we could actually see a 7.6% gain at April expiration. Am I saying that I think GSK is going to be trading at 52.50 at April expiration? No. This goes back again to why we always want to reevaluate our sentiment at the stock and reevaluate the graph of any repair technique before we enter the position as well to make sure it matches our goals. But this is one possible repair. And then lastly, we're at 12:45, so I'm going to move on through some of our other stocks there, Larry. The other thing you may want to do is considering averaging down. Do the 100 shares here at 47.65 to your 100 shares at 53. Yes, you're putting more money into a position that's declining, but you may be able to see some quicker stock repairs as well. Okay, I'm going to look. Here's some stock positions, a lot of stock positions that are in there. But let me do this. I'm going to go to some of the questions that aren't related to your stocks, and then we're going to go back through it and evaluate some of the other stocks. Carol said, when the option prices are low, should we avoid this strategy since we can't collect much premium? Well, Carol, that goes back down to evaluating the stock after its decline in price. And what I mean by that, you're asking me if the premiums are low, will I see a repair, or is a covered call even possible? Well, it's not so much that the covered call position or the stock repair would be a bad idea. If you find a stock repair even with low prices, it may help you get back to break even faster than just holding on to the stock and hoping. However, the last comment I want to make there is that when we go through to reevaluate the stock after the decline, before we consider any repair, averaging down, doing a covered call, maybe averaging down to a 3-to-1 or 4-to-1 ratio to get back to break even, well, now we have to consider the concept of, is it worth it? Maybe. No one wants to admit this, but sometimes maybe it's just better to take the loss and move on and try to make it back with stocks that are showing better movement as well. Jot something down real quick. I do apologize. One of our clients who sent in a stock position had to leave, but I'm going to jot down his numbers here so I have that ready and I can email him after the presentation. Fantastic. Okay, so that's some of the ideas there. And again, what you may want to consider, Larry, is averaging down. Your cost basis would now be what, roughly about, let's see, 235 up to 3 down. So you'd probably be at around $50.50 or so cost basis to see if you can build a repair of the stock at 47.65. Okay, let's go to some of our other positions. Same process as before. I'm going to go into the portfolio first. And we're going to add a new position here for Linda Hertz, one of my favorite trades that I used to have. And this kind of goes along with Carol's question as well, because I know Hertz pretty well. I know the premiums aren't that high. But we've got a Hertz position here. We've got a cost basis of, we're just going to use 100 shares now, but a cost basis of $27. And it's trading at around, sorry about that, 27.17, no, 27 even, sorry. The stock's trading around 21.17. Okay, so I know that there's not going to be a really good repair right off the bat for this one, and I know a covered call is not going to cut it either. But let's take a look. We're at a 22% loss on Hertz. Don't despair. Still okay. Let's see what we can do with it. I'm going to go to position actions and then position analysis again. Just doing this as to reiterate the process. We have a 22% unrealized loss. Hertz does pay a dividend still, I believe, so we've got some of that coming, but it's not going to counter our 22% loss. With a stock at $21 roughly right now, it's just even at 21, we've got a $6 loss. We know that selling the at-the-money maybe 22 or 21.50, we're not going to see $6 in premium. Even if I go out to January 2017, I'm not going to see $6 in premium, unfortunately. So what does selling the monthly or 2-month out covered call do? Well, it starts to hedge some of the loss by the premium you generate, but if the stock recovers, not even recovers fully to 27, if it goes back up to $23 or $24 per share, now we have to maybe buy back this 21.50 call for $2.50 or $3 and add back into our cost basis. We collected $70 to lower our cost basis down to $26.30. Now if I got to pay $3 back, we're going to increase that back up to $29. So that's the danger here of selling these calls once it's fallen just to generate some premium. You run the risk of getting locked into a loss or having to put more money into the position to roll the call. Again, we'll go to the custom spread tool first now, and we'll just look at those far out options, but we know they're not going to see them there. So let's type in HTZ, and let's go ahead and add in the 100 shares at 27. And now let's go ahead and go out to January 2016. We need $6 to get back to break even. The at-the-money call that's 282 days out, 215 to 245. Let's call it, roughly 230, 235 premium. That's not going to get it done, is it? And again, we're going to be sitting on this position for a long time, but still looking at the potential of locking in a 10% loss, about half of what the unrealized loss we have right now, okay? But it's still not getting us close to break even. In this case, the numbers are kind of simple to use, to look at here, but in this case, this might be one of those better opportunities. Oh, I'm sorry, let's go ahead and close that down there. Yeah, here we go. This might be one of those better opportunities to consider. Did I put in the right stock? Yeah, I did. HTZ, right? Yeah. Yeah, HTZ. Okay, sorry about that. If we average down now, really simple, 100 shares at 27. You may have more than that, I understand, but 100 shares at 27, 100 at 21. We average those two together. We'll have a cost basis now of $24 per share. Okay, but we'd have 200 shares, remember, that's key. We have to use the 200 shares. And we see some repairs for September. That's not too bad. That's not too far out in time. There are repairs for January as well. And there's some debit repairs to April and even in May. So that's something to consider, Linda, as you may want to look at those repair opportunities there on power options. Let's just look at the debit repair. It's a debit of 75 cents. Let's just look at the graph real quick. So you average down 200 shares at 24. The April 2050 call, 75 cents. And again, the 23 call is listed with a natural bid of 0. You could probably get maybe 3 to 5 cents for it, somewhere along those lines. So let's submit that. Well, now you're going to have a high debit. Okay, so you're going to buy 2 at 75, so that'd be 150. You're going to have a debit of about 144. In this case, it shows up as 148, excuse me, or 138, excuse me. So you're adding a $1.38 cost basis into the position. But if the stock is trading right at, I'm sorry, what was that strike? The 23 strike. Not too far off. Now, although Hertz keeps dropping today, I understand that's a concern. We started at 21.17. It's already down to 20.87 in just that short time frame. But if it's trading up and it moves up here, it stays above 20.50. Remember, even if it stays at 20.87, you'll get an additional 30 cents, 37 cents back for this call. Okay, so in this case, with that 20% decline, Linda, I think it might be a good idea to consider, if you're still bullish long term, is to average down the position. I'm not giving direct trading advice. I can't do that, but it's something to consider. You may be able to average down. And remember, if you have the finances to do it and it's not eating up too much of your portfolio and exposing too much of your portfolio, now that you have 200 shares, if Hertz is still paying a dividend, you'll get twice the dividend on that payment as well going forward for the next 3 to 6 to 9 months also. Okay, here's one of the tricky ones. These are always fun and interesting to see. I'm sorry, we've got, I just missed it. Michael comes in. My friend owns 100 shares of Dust with a cost basis of 24. It's currently at 16. No idea if Dust will recover, stagnate, or decline further. Yeah, it's really hard to tell, not even because of that particular sector, but because of the nature of this kind of security. A bear 3 times ETF. So it's an ultra ETF, and it's actually counter market from the gold miners. Okay, so if gold falls, we're going to see this pop. If gold goes up, we're going to see larger losses, maybe down to the $8 range. It moves very, very quickly. Okay, but let's see if we can take a look here. Because the premiums are a little higher as well, you've got a cost basis of 24, you're down $8. Let's go out to May just to see. Yeah, see the 17s are at $2. We're seeing better premiums here than we'd see for some of those other positions with Hertz Global, for example, lower premium because of the nature of this. This is definitely a position, Michael, that I would not advocate trying to do the call on because, as I mentioned, we could see this stock, oh, I'm sorry, I didn't submit that yet. We could see this stock that's trading, right now at $16.13. We could see it drop to $8 per share in the next 3 weeks. We could see it go back to $24 per share in the next 3 to 4 weeks. That's the nature of these types of 3 times and 2 times bull and bear ETFs and so forth. A repair potential, let's take a look here. Let's go back to our repair. Sorry about that. Oops, wrong one. I apologize, folks. Let's try that again. Let's go here. Let's look at dust at this price. This is one that might also be a consideration for averaging down, but it's kind of dangerous. Of course, sorry about that. $24. Let's get the numbers right here. Let's just plug in 100 shares. Quick repairs out to June, not too bad, but you're going to have a capped gain as well, some in September. And what do I mean by a capped gain? Let's take a look one more time. In this particular repair for the ETF, we could buy one June 16 call for $3.20 and sell 2 June 20 calls at $1.60. Probably get better bid and ask, so you could probably convert this into a 10, 15, 20 cent net credit for your position. But right now it's a wash, right? We're buying one at $3.20, selling 220 calls at $1.60. So we're not getting anything positive, paying in $3.20, paying out $3.20. But it gets us back to break even if the stock is trading just at $20 per share. Okay, so rather than needing the stock to go back up to 24, it's about the halfway point, isn't it? You've got an 8-point loss, so the stock recovers 4 points, then you'd be back to break even with this repair out to June. But again, it's going to be kind of tricky. With a cost basis of 24, if you've got stock now, another 100 shares at 16, think about it, you have a cost basis of $20, and looking at those premiums, let's say we got a cost basis of $20 and we go out to the standard May expiration. Well, not too good, but you could get $1 for the 20 strike. That would lower your cost basis down to 19. You're looking at a $3 loss. I really don't want to give everyone the impression that I'm saying that we should average down on every one of these, but sometimes that's a consideration. To get a repair to work, you may have to consider that to average down. If you don't have the money to average down, well, we still can look at some of these stock repairs or look at some of the call management to go further out in time. And that's sort of the nature of the game. We're going to talk about that in just a moment as well. Okay, let's see. Hold on. Jeff said, Jeff, I'm going to get to your question in just a moment. I've got a couple more of these to take. Let's see. James has a cost base. James is the next one. With a cost base on Microsoft of $45.52. Let's just run through the stock repair first just to see if anything's available. We know kind of the premiums we see there too on MSFT. So we've got 100 shares at $45.52, I believe you said. Yeah, after selling some calls against it, 100 shares. Some repairs out to October. Okay, so using the 41 and 43 strike, generate a 52-cent credit out to October. Let's look at that analyzed trade there, James. Okay, just to break even though. But the new break even is at $43. So instead of needing the stock to go back to 45, you'd only need the stock to go back to 43. But this is right on that cusp of the time frame I worry about, where it's 5 to 6 months out in time. We're going to be sitting on the position for a long term, depending on your outlook for Microsoft. Remember, you do have earnings coming up probably within the next month or two. That's part of the evaluation we'd consider in all of these repairs, that earnings are coming up. And that goes back to the question that was popped up about 2 minutes ago by Jeff that I want to address to about using puts with this combination as well. Okay, and because you can see the glaring downside here. Of all the repairs I've done, this is helping you get back to break even faster. But what do we notice? We need a bullish expectation. We have to have the stock move back up in order to get back to break even. If the stock continues to fall, Well, we generated maybe a little bit of credit against it, or maybe we generated a decent amount of credit against it, but the stock can still fall against us, and we've done nothing to hedge the downside. So James, based on your expectation in your portfolio, which I can't give you any guidance on because I'm not a financial advisor, the consideration here is to maybe consider, again, that combination. Average down first, maybe. So you'd have a cost basis of roughly about $43.50 per share with the stock at $41.18, and maybe see what repairs are available at that cost basis. Last one of these types, and this one looks like it's going to be pretty good. It's Stash. I'm sorry. Stash asked a question here. SCTY, 100 shares at 57. Okay, let's go. Oh, sorry, folks. Oh, sorry about that. Hold on here. There we go. I apologize. Let's go back to just the stock repair first. So SCTY, 100 shares at 57. All right, let's go ahead and run that through. Decent amount of repairs here in April, some in May as well. The stock's at 54.07, so you have an unrealized $3 loss on the position. Now let's just take a look at the analyzed trade here, looking at a 55.5 strike for April expiration. Minimum net credit of only 38 cents with this repair, but let's take a look at how it happens. All right. So we have SolarCity at 57. I could buy one April 54 call for $1.96 and sell two April 55 50s for $1.17. So this would give me $2.34. That's our 38-cent net credit to lower our cost basis. And if the stock is trading at 55.31, just $1.31 above that, at April 24th expiration, I'm sorry, this is the third week out, so it's the 24th, not the standard 17th, you'd have a small profit of 0.7%. Where the stock is still roughly $1.70 below your original cost basis of $57. Small profit, of course, and there's the break even. This is a repair that will work better than simply selling one call at the 54 strike or selling one call at the 55.5 strike. Due to that exponential gain, as the stock moves back up as you're expecting, then you could see that bump in both the gain in the stock and now the gain in the long call that you were essentially paid 36 cents to own. And, of course, you still have a capped gain. Why is that relevant? Well, the one thing you've got to consider here, I'm sorry, if I go to the research tool for SolarCity, this was the April 24th. Oh, hey, that works. I like it. This was an April 24th expiration repair stash, and it's unconfirmed, but the earnings are supposed to be around 5.6. So I try to verify when the earnings are coming out for SCTY. The reason why this is important is although you have a capped gain, if the stock does recover, moves back closer to about $55 at April 24th expiration, you'd be closer back to break even with still earnings coming up a week or two away. Now, that's where I'd want to potentially hedge the downside in that case. You could go into it looking at another repair. Remember, if this repair goes as you want, let's say the stock ends right at about 54.80 or 54.90 here at this, about 54.80, 54.90. You sell to close that long 54 call, get 80 to 90 cents back, you'd be close to break even. Then you could still evaluate another repair with your new cost basis of around 55.10, 55.05, with the stock trading around 54.80 to see some potential repairs to increase that upside. But remember, you'd have earnings coming up, and if you're expecting a positive earnings, again, we never know, but if you're expecting a positive earnings on this transaction, you have to remember that you have a capped gain. So depending on your reevaluation of where you think the stock might be going, it could be dangerous. Jeff asks, can these trades be done in a self-directed IRA? That is the prominent question, isn't it? And depending on the restrictions, Jeff, in your IRA, you might not be able to do this repair. Okay? And what I mean by that is, of course, what are we doing here? Well, we're selling two calls and buying one. Now, your broker would look at that. If we just did that by itself, your broker in your IRA, your restricted account, probably wouldn't let you do it. It ends up becoming a ratio call spread that has an infinite risk to the upside. Because without the stock, you've got the bull call spread, in this case buying the 54 and selling the 55.5, but then selling another 55.5, so now you've got a naked call with the bull call spread. So your broker won't let you do that. When you add the stock back into the position, was that right, 54? Oh, no, it was 57, right? Yeah, 57, I'm sorry, $57 on SCTY. All right, so we got the stock at 57 there. When you do this, essentially what your broker sees is he'll look at it as just a covered call with a bull call debit spread. All right, so let's take out the stock again and take out one of our calls. So there's your bull call debit spread. You bought one call, 54 call at 196, and you sold one call at 55.50. So that's just the bull call spread. The other legs of it, we have 100 shares of stock at $57, and we sell, we sell another April 55.5 call for $1.17. So what we really have here is a covered call with a bull call debit spread. So the true answer to your question there, Jeff, is that if your self-directed IRA, if your brokerage allows you to do credit and debit spreads in the IRA or even debit spreads, you will be able to do this. If it's a really restricted account where you can only, let's say, buy stock, sell calls as covered calls against those stocks, and maybe buy calls and buy puts, they don't allow you to do spreads, you won't be able to do this. But what could you do? Is there a way to repair this a little bit better than a static covered call in a self-directed IRA? Maybe. And let's talk about what that is. Let's clear everything else out but the stock position. We have 100 shares of stock at $57. I'm sorry, that was the it was the 54 and the 55.5 for April 24th was my position here. Okay, so I can't do a bull call spread in my retirement account. I've got a loss here on SolarCity with a stock at 54.07, $3 down. Okay, I could just sell a covered call. We talked about that. But how about this? Let me average down. Let me buy another 100 shares of 54 if I have that capital available. So now my cost basis, right, is going to be 55.50 on this position. And I now own 200 shares. How about this? Let's do that ratio repair again, but this time in just the static 2-to-1 ratio. Go to April 24th. We were looking at the 54 to the 55.50s. Okay, let's call it 180 to 195, a 15-cent bid-ask spread close to it. That's about, 18 cents bid-ask spread. So let's put 9 cents in. Let's call it $1.87 to buy the 54. But we're going to buy one. What did I say, 187? I'm sorry. Yeah, 187. And then we're going to sell two, 117 to 132, about 15 cents or 17 cents or so. So let's, 15 cents even. So let's call it another 7 cents. It's called $1.24 for selling. Two. Okay, so we're at 54.550. We've got a $1.50 loss because our stock's trading at 54. Let's go ahead and submit that with this ratio call spread. Break even is now 54.80. Okay, so remember, we originally bought stock. Let me show this graph again. You originally had a cost basis on SolarCity of $57. Okay, the stock's at 54. We averaged down to get a new cost basis of roughly 55.50. And doing a 2-to-1 repair on our 200 shares of stock now, we have a break even of 54.80. We're buying one call again at 187 and selling two at 124 for 248. Now, this we can do in any account where we're qualified to trade options, because all your broker is going to see is that, hey, you entered this as a covered call. You averaged down to get 200 shares of stock. You sold two calls, the April 55.5 call for $1.24. You took away some of that premium to buy one call at 187. So all you did is buy a call and sell a covered call. You still have a ratio call spread in here with a $1.50 potential extra increase as the stock moves up above 54, don't you? Okay, so now as the stock moves up, we're gaining on the 54 call. We did generate about 60 cents of premium to lower our cost basis, and we lowered our cost basis to begin with by averaging down. And by doing this 2-to-1 ratio, just keeping the ratio at a static 2-to-1, not increasing it to 4-to-2 or anything like that, but doing the standard one against 200 shares of stock still might help you get back to break even faster, still gives you the advantage of the increase of the bull put credit spread as the stock moves up, allows you to do it in an IRA account because you've sold two calls against 200 shares, and because it's not twice the ratio. It's not a 4-to-2. You don't have a capped gain. As the stock moves up, let's say it recovers, moves up to 57 or 58 or even $60 per share, well, you may be assigned your 2 calls at 55.5 and have to deliver your shares of stock at 55.50, but now you have a 54 call that's continuing to gain in value as the stock moves up in price. So that is how you can get around doing this in the IRA. If you average it down and now you have 200 shares, you have 400 shares, if you keep the number of contracts that you sell equal to the number of shares that you own and just buy 1 call against it, well, you're funding the cost of that 1 call with the bullish expectation on the position. Now, we have 200 shares of stock. We have a ratio repair that gives us an infinite upside because we still have the long call and 2 short calls and 200 shares. So we have a covered call with 200 share block, which does normally cap our gain. We've got this extra long call that we were paid to own. And the difference here is about 60 cents, isn't it? Paid out 187, collected 248 for the 2 calls. So we're taking in a total net credit of 60 cents or so. Okay, now why is that important? Well, in order to protect this position, as Jeff mentioned, could I add a put now into this position to hedge further losses if I'm wrong and the stock continues to move down? Yes, you could, but it's going to change the dynamic of the position. Remember, we only have 60 cents in, and we have 200 shares. So to fully protect the 200 shares, I would have to look to buy 2 puts with a premium of less than 30 cents. Okay, so let's go to the same expiration. And we see the 48.50 put here with a cost basis of 18 to 49. Wow, that's wide, isn't it? Wow. Sorry. So that's a 31 cents difference, about 15-cent midpoint, so that'd be about 33 cents even. So let's try that. I'm going to buy 2 puts at 33. This is going to negate that 60-cent net credit I took in. Still leaves me with an infinite upside. Okay, let's just look at the on expiration value. But my break even now goes back up to 55.02 from 54.80. Why? Because of the cost of the put. I've hedged this further now to where I can't lose more than 12.7%. We only have a small loss of $3 on this position for 100 shares or $600 for 200 shares, but now we've capped the loss here if the stock drops below 48.50 to a 12.7% loss. That's 6 points away. So we have to evaluate now, is the insurance worth it for what we're looking to do on this position? Okay, that's where that comes into play. Can you add the put with these repair strategies? Yes, you can. You'd want to take your net credit or half of your net credit, see what puts you can buy, but remember, it's still a large gap, and is it worth it to take the premium away for the stock to drop another 6 points is roughly what you're protecting, a 6-point drop. And earnings season, I don't know, maybe that is worth it. But remember, on this particular one, the SolarCity, this put that we just bought for the 24th of April is also going to expire before potentially the earnings come out. We have to confirm the date as part of our stock reevaluation once the decline happens. But that's one of the things I'd have to address as well, because if the earnings are coming out on April 21st or April 22nd, then I'd have to really consider, is a repair strategy worth it? This repair would be, leaving the upside open and protecting the downside in case there's a 6 or 7% drop. But again, it depends on my outlook for the stock, and I'd want to do this other ratio going into earnings, so I leave the upside open rather than capping it if it can still reasonably help repair my position as well. All right, so those were just some of the features that we wanted to share there. Oh, I'm sorry, let me go back one here. There we go. All right, I'm going to navigate back over here to some of our wrap-up. If you have any last-minute questions or last-minute thoughts, go ahead and send those to us. But remember, evaluating a stock repair, if you have a small loss on a stock or a covered call or naked put position, we're in the range of maybe a 3 to 7% loss, use the Power Options portfolio tool to evaluate the roll-downs or the rollouts that might help you get back to break even. Before you do any adjustment, always reevaluate your sentiment on the stock. If I had a covered call position where I generated 2 or 3% premium and the stock dropped 5%, so I'm an unrealized 3% loss, and I'm concerned that the stock may continue to go down, even if I can roll that call out to the next month and collect another 3% to put me right at about break even where the stock's currently trading, if I'm thinking the stock's going to fall in price, I may just want to get out of the position, take the small loss of 2 to 3%, and look to make that up somewhere else. That scenario, with a small loss on a covered call and you're evaluating rolling down the call, is probably also a good time to consider buying a put at that time to help hedge any further losses, but still maybe hopefully get back to break even as well. So for larger losses, as we looked at today with some of our positions, if you're above a loss of greater than 10% or so, 9 to 10%, rolling might not be the best in the desired position. Okay, so you could roll down. We saw maybe 1 month or 2 months out in time. We may have to roll 4 or 5 months out in time. But think about it this way. On average, right now, the 30-day out at the money call time value is around 2.4% on all options. Okay, so if you generated 2% and the stock dropped 10% in the first month, you are at an 8% unrealized loss in your position. If you roll just 1 month out and collect another 2%, you're still down 6%. Remember, the option that is 3, 4, or 5 months out of time is not going to be 3, 4, 5 times the cost. In order to get that 8% back, you're going to have to roll maybe 9 to 10 months out. Is that really worth it? Probably not, but you want to use those power options tools to evaluate that as well to see. So rolling might not be the best desired option with those losses around 10%. Evaluate the stock repair. For a quicker repair, you might be able to see something closer in time with a stock repair to get you back to break even. And we saw in most of our examples today, some of the best solutions were combining the management. Average down first, and then take a look at the stock repair. But don't, when I say average down first, I'm talking about running the numbers of averaging down first. Don't go ahead and average down and then look for a stock repair. Actually place the trade in your portfolio. Simulate it first. Simulate your new cost basis, what your average price would be. See if there's a stock repair with your new 200 shares or twice as many shares you started with your new price. See if that works before. And then always, I sound like a broken record and I apologize, always reevaluate your sentiment on the stock before you do any adjustment. Don't roll. In other words, don't roll for the sake of rolling. I have a covered call that's fallen in price. I read somewhere on the internet that the best thing to do is just roll down the call, and if it continues to fall, just roll down the call, go further out on time, and so forth. Remember, when you're doing a covered call, or even if you're in a naked put position, the stock's fallen and you put the stock early, just remember that now you're in a stock position, and what you have invested in the stock is, regardless of what call you sell, is probably going to be 98 to 97% monetary value of the position. As the stock falls in price, you're always going to lose more on the stock than you can gain back from rolling the calls. So eventually, you have to hit a point where you have to say, I can't keep rolling for the sake of rolling. I've got to get out of this position before more losses are realized. So you always want to reevaluate your sentiment on the stock now that the event has happened. For losses beyond 25%, we kind of saw one today, didn't we? We were close to it with that 22% decline on, I think it was Linda's position, I don't remember. Maybe it was the bigger one for the 3 times ETF. But just a standard averaging down might not work. No one wants to do this, and I sincerely advise against it. But if you've got a 25% loss, you may have to do a 3-to-1 averaging, meaning if I bought 100 shares, instead of just buying a new 100 shares at the lower price, I may have to buy 200 shares, so essentially a 2-to-1 or 3-to-1 averaging down. That gets very expensive, and you're throwing a lot of good money into a bad position potentially. And then maybe you'd have to evaluate the repair after that type of averaging down. But again, it's always essential to reevaluate the stock. No one wants to take a loss, especially one this big. We talked earlier about gambler's ruin, how a 25% loss, you're going to need a 33% gain on what you have left to get back to break even. If you suffer a 33% loss, you're going to need a 50% gain to get back to break even. So no one wants to take these kind of losses that can happen, especially now around the earnings events and earnings dates, where we may just see sudden gaps from an unexpected event in our position, where even something stable like Microsoft could see a 10 or 20% decline in the stock price. Of course, we're talking about $4 to $8, but that is immense on a stock that doesn't have a lot of premiums, pays a small dividend, but it's not going to counter that $4 loss or $8 loss. Do we see Microsoft typically have that 10, 20, 30% loss after an earnings? Not really, but remember, anything can happen even with the most secure stocks. All right. Now, main question is, can we avoid losses to begin with? Well, the important ways to avoid losses on our positions is, number one, we always want to practice proper position sizing and trade management. We talked about the preemptive trade managements. We talked about some new ideas today to manage positions where we're long stock, either put a stock through a naked put, just owning stock outright, or for a covered call position that has declined against us. But in any situation, and again, I have to reiterate that this is the risk of the averaging down concepts we talked about today. You have to make sure that too much of your portfolio is not exposed into any one position. You'll hear this ad nauseum throughout looking up ideas on the internet for options trading and everything else. whatever cliche you want to use. Don't put all your eggs in one basket and so forth. You've got to make sure, though, it is really important that you have proper position size there as well. Develop a trading plan and stick to it. Part of you, many of you, I'm sure, are trading positions such as covered calls right now. You may have some naked puts. You may be doing spread trades, and you may be speculating with some long calls or long puts there. Well, what you want to do with that kind of portfolio is make sure that the most conservative strategy represents the largest portion. In other words, if your strategy you're using standard collars, I would want to make sure that my standard collar positions represent close to maybe 20 to 30% of my total portfolio allocation. Something speculative such as buying calls or ratio spreads or even just standard credit spreads, I probably only want to have 10% of my portfolio allocated to those more speculative positions. Okay? Now, what about insuring the stock directly or insuring your portfolio? Well, Jeff just pumped in a question. If you hold a stock without a put and earnings are 35 days out, how far would you buy puts? Well, that depends on your expectation, Jeff, and it depends on your cost basis. Personally, I'll talk about this in a moment, but personally I follow the radioactive trading techniques where I'm always in a long stock position that has a put when I originally open it that's 5 to 6 months out in time. So I'm looking for growth, and as I cross 2 to 3 earnings cycles, I've got that protection in place, and I'm guaranteed not to lose more than 4 or 5%. But if you're just looking for a shorter term play, you may want to consider using a shorter option. Some other ideas that one might consider are insuring the portfolio. So you can insure stock directly, but if you've got a nest or a bucket, I should say, of 25 stocks in your portfolio now without any options against them, buying 25 individual puts in those securities may get very costly. But if you're bullish on those stocks, it's still going to work out. It's still a bullish position. You're probably not putting too much per trade into the put insurance. Remember, put insurance works just as like any other insurance. If I buy a 1 month out, deep out of the money put for 20 cents, well, that doesn't give me a lot of insurance. Yes, if the stock drops 10, 15%, that deep out of the money put might not kick in yet. If it drops 30%, sure, it'll kick in, but I'll still be at a 20, 15% loss perhaps. Meh, not really doing it, is it? Or portfolio insurance. What do I mean by portfolio insurance? There's ways to insure a portfolio by potentially evaluating buying puts on the broad-based indexes, but better yet, it's the ETFs. The broad-based indexes can get expensive with those higher strikes, but maybe SPY, QQQ, IWM, sort of those ETFs. You may be able to buy puts on those. Now that helps against a large market correction, but not necessarily on earnings. For example, if I own Microsoft and I want to protect it, and I notice that I have several other stocks that are in the tech sector, Apple and Netflix and things of that nature, and I buy puts on, let's say, on the cubes. Okay, I buy out of the money puts on the cubes. We come to earnings and Microsoft drops 20%, but the NASDAQ as a whole is up 1 or 2% that day. I'm going to lose on the stock and potentially lose on the put. This portfolio insurance of using puts or on the indexes or ETFs, or doing calls on the counter market, or buying calls on the VIX, which will move up in price as the market falls, or counter market ETFs as we saw earlier with that bear ETF, 3 times ETF on the gold miners, what we call the counter market positions. Those are designed to hedge against a black swan and unexpected market event. Not necessarily great in earnings season to protect a portfolio because, as I mentioned, you could have the one stock that drops 25 to 30%, but everything else in that sector might be moving up, or everything else that's represented in that kind of group of ETFs, SPY stocks, SPY 100, or the S&P 100, S&P 500, for example, that could be up that day when your stock collapses and your put has lost value that you put in for insurance, and your stock has lost a lot of value as well. The best insurance is to insure the stock directly. It is more costly, but again, we come down to that evaluation. You get what you pay for. Okay, very quickly, let's talk about some of the resources for limiting your risk. A recent article we published, you all probably saw it in the newsletter that we sent out, is sort of the barbell approach for investing. You want to balance your portfolio to conservative positions with the larger bulk of your portfolio and speculative positions with the smaller value as well. What I'm going to do right now is send everyone a link. We can just go to www.blog. You can access this, of course, if you're on Power Options. But if you go to that link there, blog.poweropt.com. Oops, I'm sorry. I think it's just blog@poweropt.com. I apologize. I hate when I do that. There we go. Okay, so let's change that. It's just blog. There we go. Okay, blog.powerup.com. That link there, one of the recent articles we published on April 22nd is related to this conservative barbell strategy with setting up a conservative portion of your portfolio to a speculative. We have some discussion on that as well. And, oh, I'm sorry, I'm not showing my screen, am I? How about that? There we go. Let's go to there. Didn't show it. Now it is. All right, so right on the blog there, which you can access while you're on Power Options, or you can just go to that link, blog.powerup.com. You'll see the link here for a balanced approach for portfolio success. Okay, some of the other references that we have for you, we talked about that stock or portfolio insurance. Okay, and if you go again, let's go back to that view. If you go back to the blog, inside the blog there, you've got the search view up here, and I can put in stock or portfolio insurance into the search field. Okay, right up there at the top. Sorry about that. So we put that in there up at the top. And then we go ahead, let's just submit that there. All right, so here's a couple articles here from March 13th, 2014, Stock or Portfolio Revisited, Portfolio Management, and 4 ways, here's an important one here, 4 ways to ensure your investment portfolios. This is from 2011, but it does go through some of the different discussion there that we talked about before, comparing puts on the indexes and ETFs, calls on the VIX versus insuring stock directly. So going to the blog there and just running that basic search for stock or portfolio insurance will give you some good articles as well. In addition to that, back on Power Options in the free webinars tab, the link there, I'm sorry, let me just put the link in there for the webinars page. It's a public page. You don't need to be logged in and look at it. If you go to powerup.com/webinars.asp, here in the Power Options Tools section, this, I just want to show you this. This Repair Your Sunken Stocks, which is pretty old. That's going to be replaced by today's presentation. And today's presentation is going to be available in the Options Concepts one. You'll see that up at the top here for Manage Your Broken Stock. But that other one I wanted to mention here, in addition to the blog article, we did a video on it as well. So evaluating stock or portfolio insurance, if you go to powerup.com/webinars.asp, click on the Options Concepts tab there, and then you'll see the one for stock or portfolio insurance to give you a little bit more in depth into that discussion on using puts on the ETFs and indexes, calls on the VIX versus insuring stock directly. But you can also find the article on the blog as well. And lastly, of course, we talked about the best way to insure your stock positions, of course, is to insure them individually. When we talk about the radioactive trading techniques, many of you are probably familiar with those. You can read more about that at radioactivetrading.com. If you haven't done so already, I'll encourage you to do that and then take a look at the sketch as well. So the sketch is a free white paper that introduces the radioactivetrading.com concepts, or the radioactive trading concepts, I should say. And let's change the screen here. And I just want to go to radioactive trading. Here we go. All right, now we're seeing my screen. Fantastic. Okay, so up at the top here, if you haven't done so already, I use this with roughly 50 to 60% of my trading capital. So if you haven't gotten the free white paper already, just go ahead here, put in your first name, last name, and email address, and click Get the Sketch. So it's a free 9-page, 10-page white paper that discusses our preferred approach for insuring stock with put positions and then being able to pay for that insurance over time. In addition to that, if you want some other information on insuring stock positions one-to-one, if you go back to the webinars page, go into the Option Strategies view, you'll see a couple of older webinars here on Protective Option Strategies Part 1 and Part 2, a comparison of using collar spreads, standard collar spreads, and married put positions to insure your stock position as well. All right, so there's, let me just go back to the slide there. There's the reference there. We'll walk through them one by one real quick. Oops, sorry about that. There we go. All right, so resources for limiting your portfolio risk. The barbell approach for investing, go to the blog, blog.powerup.com, or if you just go to powerup.com, you can click a link to go to the blog. Take a look at that most recent one to see how to balance your portfolio and discussion of some of the speculative techniques we prefer versus the conservative techniques inside the barbell approach we prefer. If you're interested in that discussion of insuring your stock or portfolio directly, on the webinars page, remember the options concepts, you'll see that stock or portfolio insurance presentation. You can also go to the blog and look up stock or portfolio insurance to see several links there. And related to insuring stock, which is our preferred method, insuring stock individually, go to Married Puts and Collars. You can go to radioactivetrading.com, get that free white paper, The Sketch, or in the webinars page under Option Strategies, take a look at the Protected Option Strategies Part 1 and Part 2 as well to see a comparison. Michael did mention earlier, said thanks again. Is a recording of the seminar available to view again later? Roughly at around 4 p.m. or 5 p.m. Eastern Time this afternoon, I will have this webinar posted. Again, as I mentioned, it will be posted here at powerup.com/webinars.asp under the Options Concepts position. Okay, under Options Concepts tab, you'll see it here right above the weekly options discussion, implied volatility, and the Greeks as well. And of course, you still have that stock or portfolio insurance one right there also to view at any time. I'm sorry, Jeff says, I have a very diversified portfolio, 60 names. What % would you have in the radioactive trading method? Honestly, Jeff, if I'm long stock in my portfolio now, it is either as a married put position, a radioactive trade, or a standard collar position. I don't have any stocks that I just hold. All the long stock positions I have are optionable, and I trade them as radioactive trades to keep all of my risks within the 5 or 6%. And some of you have heard me say in other webinars, over the last 5 or 6 years, I've been able to meet my goals of averaging around 10, 11% per year with 50 to 60% of my trading capital allocated to the radioactive trades. Another question came in about the trade allocation. I don't know what's going to work for you, honestly. Okay, read that barbell article, get an idea there on that concept. General, what's worked for me in the past 5 to 6 years, why I've continued to do it, is that at any given time, 50 to 60% of my total portfolio value is allocated to the radioactive trading positions. Another 15 to 25% or so is allocated to standard collars, still protected positions, but slightly different. Another maybe 10% or so of my portfolio, I still play around with diagonal calendar spreads, and then another 10 to 15% of my portfolio is allocated to credit spreads on the broad-based indexes and ETFs, kind of following the barbell approach pretty closely, but with 2 different types of positions on the conservative side and 1.5 kind of strategies on the speculative side as well. But that'll be more clear what I mean by that when you read that barbell approach. That's just what's worked for me. Okay, it might not work for everyone. I do have several power options customers who are successful trading year after year, who maybe do some of the protected positions, collars, radioactive trades with only 10 to 15% of their account, and have 20% of their account allocated to deep out of the money naked puts or potentially in the money covered calls, while still doing some credit spreads and maybe some long straddles or long straddles as they approach earnings. Everyone has their own little system that works for them. I can just tell you what's worked for me. This goes back to what we were talking about before when we talked about allocating that trading plan and evaluating your stocks before doing any adjustments and adhering to that trading plan as well. All right, and just in case anyone had a question about it, also in addition to going over to radioactivetrading.com and getting the sketch, if you haven't done so yet, if you haven't started your trial, we showed the tools, the powerful portfolio tools, the stock repair tools, the rollout opportunities through the portfolio tools. If you haven't done so yet, go to powerup.com and sign up for that 14-day free trial. No credit card is required. Afterwards, of course, our services, our 20-minute delayed service on Power Options is $60 per month. We do offer a historical suite of tools for back testing, and that's $100 per month if you get the 20-minute delayed plus the historical. We, of course, offer a real-time service. Every time you refresh the page, you're getting the numbers and calculations at that instant. That's $100 per month. And, of course, we have discounts for the annual subscriptions as well. Well, I didn't see any last-minute questions come in. I hope you all found today's presentation useful for your portfolio and for helping you to repair some of your positions, some new ideas on how you might repair some of your sunken stocks or sunken covered calls. If you have any questions later on, go ahead and send me an email to support@powerup.com. Remember, you can also call us during market hours here at the office at 302-992-7971. We also have contact links at the bottom of every Power Options page. Well, thank you again, ladies and gentlemen, for joining me today. Happy trading. We hope to see you all again soon for one of our next upcoming live presentations.